day, everyone, and welcome to the Tuesday's edition of the premium video newsletter from Market Geeks. Lots to get into, so let's start off with the fundamentals and work our way into the technicals from there. Two key reports gave a mixed picture of the U.S. economy. One showed that home prices in July rose the most in more than 7 years. Another report from the Conference Board, a New York-based private research group, said Tuesday that its consumer confidence index dropped to 79.7 in September. That's down from August's reading of 81.8, which was slightly higher than previously estimated. What this tells us is Americans' confidence in the economy fell slightly in September as many people became less optimistic about hiring and pay increases. Consumers' confidence is closely watched because their spending accounts for 70% of economic activity. The September reading was only slightly below June's of 82.1, the highest in 5.5 years. Let's start our analysis with the bond market, since this is where Wall Street's attention is currently focused on. We're approaching a 30-day high and are only a few ticks away from matching that number. However, we have divergence between the RSI and the market price. The RSI is once again heading towards deeply overbought levels. Knowing how choppy the bond market is historically, I wouldn't be too emotional about these levels right now. We do need to see what tomorrow's government releases have to say, but overall, the market priced in the fact that the Feds are going to continue putting money into the market for several more months. Remember, this is still merely a band-aid, and the smart money knows this. The market is reacting positively to negative news because it reinforces that the Feds will in fact continue putting money into the market. We have to be mindful of that right now because this is what we're dealing with at this time. I'm looking for shorting opportunities at these levels and will notify you if I see anything come up in the next day or two. The price of oil slipped below 103 a barrel for the first time since early August, as the U.S. signaled a willingness to pursue a diplomatic path with Iran. On a technical level, we saw an island reversal today. We saw one to the downside, which signaled a peak in the market, and we sold off from the 109 level all the way down to the 102 level in less than 1 month of trading time. Now we have the same pattern to the upside. While I do think the pattern is valid, I'm substantially more bearish than I am bullish right now, especially in light of Syria cooling off. There's still an issue with higher global demand of oil, and there's lots of evidence that suggests that that's currently the case. So we may rally to the 107 or possibly to the 108 level. But I'm giving you my opinion, and right now I'm not seeing much upside in this market. I would rather wait for a little rally and sell than be stuck on the wrong side of the market in case we fall sharply. Let's cautiously watch the upside, but I would avoid taking long positions in this market right now. The next market I'd like to look at is the gold market. Most of you know I'm bearish long term on the gold market, and nothing has changed. However, we had an island reversal at the same time we had one in the crude oil market in late August. We sold off from the 1440 level to slightly below the 1300 level, and now we have a similar pattern going back up. I think it would only be natural for us to retrace a bit of the move we saw to the downside. I do believe we're slightly overdone to the downside, and the divergence we're seeing in the RSI is confirming my suspicion. Don't be surprised if we see a rally to the 1370 or 1380 level. We may not go that high up, but we should see some pullback at least during the next few days. So be prepared for this before initiating positions to the downside. The last few days I've been pretty much in tune with the broad stock market. As I anticipated, the sell-off continued, and today we opened higher and dropped throughout the trading day. This is indicative of a weak market environment. I believe the next realistic support level is at the 1680 level, which is exactly where the 50-day moving average is currently at. Let's take a look at a few subsectors to get a better idea of where the market is headed. As most of you are aware, one sector I like to look at is the transports, when markets are at crucial turning points. I'm actually surprised at how much strength I'm still seeing in this sector. However, and this is a big however, the transports are only about $2 away from the 50-day moving average. If we have a few more down days, I believe we will start hitting the 50-day average, and that can cause trouble for the broad market. Taking this into consideration that the tech market, which is partly responsible for the strength in the market, is overbought right now, I have strong reservations to the upside for now and believe the upside is rather limited, to say the least. Another subsector I want to look at is the financial sector. And yesterday I alerted you that we crossed the 50-day moving average, and today we continued moving lower as we anticipated yesterday. This is another major factor that's giving me pause about the long side of the stock market right now. We need to see what the numbers tomorrow morning bring us, and I do believe we have to be cautious right now with the stock market at these levels. Expect a correction in this subsector, and remember this is a tradable ETF, so expect us to go down to the $19.40 level, especially if the tech sector starts breaking down. The final stock market subsector I'd like to analyze is the semiconductor sector. This has been the strongest subsector during the entire September month, and it looks to me that we have two signs that are telling us that the swing high may be over, at least for the next few weeks. First, we have divergence between the RSI and the chip sector, and just as importantly, we are once again very close to testing the 80 level on the RSI that we backed off from just a few days ago. Remember, the chip sector is one of the biggest reasons why the broad market made a new high last week, and it looks like it's running out of steam. In a whole, taking the sector with the rest of the subsectors, I'm going to conclude that we're limited to the upside right now, and traders should be very cautious going long. If you have long positions in this market or any sector of the stock market, you may want to lighten up your position or place tighter stops, because it looks like the sectors are all telling us one thing: the stock market is losing steam to the upside. Lastly, the US dollar looks to be moving in our direction. Our analysis seemed accurate, and I do believe we will hit at least the 81 level before turning back down. Remember, the dollar will rise. It's only a matter of time till the Feds start cutting. And savvy fund managers know that. So for now, I would be cautious and would warn you against going short, at least for another few days, so we can get some better sense of direction from the dollar and the rest of the foreign currencies. There's only one setup for tonight, and it's another tail gap to the downside. It's a lower price stock, but right now there's not much out there. Due to the range-bound action we saw during the last few weeks, stocks are not trending in any particular direction, so we have to be extra selective with our setups. The ticker symbol is ROVI. Place a sell stop 10 cents below today's low, and if filled, place a buy stop 15 cents above today's high. I'm expecting some volatility tomorrow and the following day across most sectors, so be careful and watch your upside in the US stock market carefully. Have a great night, everyone, and I will touch base with you tomorrow midday as usual.